Hi, my name is Anuj Jindal, and today we are going to talk about a very simple yet very important concept in finance called as risk return trade off. You can subscribe to my free 20 days RBI Grade B video course by logging to my website, that is www.anujindal.in. There is also a 20% flat discount available on various paid courses on the website. You can enroll in those courses and use this 20% flat discount running at present. So let us start our discussion on risk return trade off. There are various decisions that an enterprise is required to take, and they can be broadly defined or broadly divided into two kinds of decisions for ease of understanding. Number one, investment decisions, and number two, financing decisions. Now let's understand investment decisions with the help of an example, and then we will move towards financing decisions. In investment decisions, there are two situations or two choices that an enterprise has. Now, investment decision briefly means the investments that the enterprise or the company wants to make. For example, I have a company that makes cycles, and tomorrow I want to buy a new set of machineries in order to produce high end and better cycles for selling in the market. Now, this decision of purchasing machinery from the market is going to be an investment decision because the enterprise or the company is investing in certain machinery, is investing in certain financial or real asset in order to take advantage of the opportunities in the market. Now, what are the two choices that he or she has? He can either go to Germany, he can either go for machinery from Germany, which is going to cost $1 million, or he can choose machinery from China, which is going to cost only $1 lakh. So this is only 10% of the cost of machinery from Germany. Whereas there are certain differences in the features of both these machineries because it costs so less. So there are going to be some disadvantages attached to this decision. Number one, life of German machinery is 10 years, whereas life of Chinese machinery is only 2 years. Now you might think that if he buys 5 set of machineries, he can actually have an advantage because the cost of machinery from China is only 10%, so he is still saving 50% here. However, there will be some cost and certain time lag involved in installation and running of these machineries as well. And therefore, replacing the machinery every 2 years is also going to cost the company certain revenues as well as certain other disadvantages of reinstallation at the same plant again and again. There will be certain depreciation advantage that machinery from Germany will bring because if the life is 10 years, then every year $1 lakh is going to be shown in the books of the enterprise as depreciation, and this will save certain amount of taxes for the company. Whereas there will be less depreciation charged on this machinery, and therefore the tax advantage is also going to be less. And whatever money extra is saved in terms of tax from machinery from Germany, that is a cost saving for the company. Another feature of German machinery is that the maintenance is very minimal. On the other hand, Chinese machinery requires high maintenance and the breakdown is also more regular than machinery A or machinery from Germany. Keeping in consideration all these advantages and disadvantages, the company is going to assess all these advantages and disadvantages in quantitative or numerical terms, and whichever decision or whichever choice is more advantageous to the company in terms of more revenues and less cost, that decision will be taken by the company. So there is a certain risk involved in deciding which investment to make, and there is a certain set of returns involved from both these decisions, from both these choices that the industry or the company has. A trade off between these two will be set off or will be decided by the enterprise before making these decisions. So, the risk of having to replace it every 2 years or the risk of more breakdown is something that the company will have to assess whether it wants to take that risk or not, versus the cost advantages that this life of 2 years or high maintenance and breakdown but less cost brings to the enterprise. So this advantage versus disadvantage calculation is called as risk return trade off. Let's take another example to understand how risk return trade off works in financing decisions. Now, there are two situations here, or two sets of parties here. Number one, there are equity shares, and number two, there are bonds or debentures. Now, what happens in a financing decision is that a company goes to the market in order to raise some funds. For example, I have a company that makes headphones. Now, what I do is that I go to the market, I want to raise some money, I go to the capital markets, and I say that I want, let's say, $1 million in order to invest in certain other enterprises or certain other projects. Now, I want to finance this $1 million from the market, and therefore I will have to make some decisions as an issuer. As an issuer of equity shares or bonds, these are the two major choices that I have. I will have to decide what my portfolio of financing should be. Should I issue more equity shares in the company, or should I issue more bonds or debentures? What are the risks and what are the returns that are expected out of issue of equity shares? There is less risk for issuer, and the reason for that is, if for example tomorrow the issuer goes bankrupt, the company goes bankrupt, then equity shareholders are the last ones who will be paid by the company, and therefore the company is more safe with respect to paying back to the equity shares, because they are owners of the enterprise, and they are also liable for whatever losses the enterprise incurs. On the other hand, the expectations of the owners or the equity holders are higher from the company, because they are taking more risk. The risk for equity holder is more, whereas the risk for issuer is less. Similarly, the return requirements of the equity holders are more from this enterprise, because he's holding equity shares and he's taking the risk of having to let go his investments in case of bankruptcy. On the other hand, what will happen if the company decides to issue bonds or debentures? There will be more risk for the issuer, and the risk for issuer is more because he has to pay back the money taken from the debenture holders, no matter what his profits or what his condition of the company is. For example, after the investment, the company incurs a heavy loss and there are no profits. But even in that situation, the company has to pay back in terms of interest to the holders of these bonds and debentures, that is, regular interest payments. On the other hand, the return expectations of the bond or debenture holders are lesser, because they are taking less risk in this case. Because in case of bankruptcy, these bonds or debenture holders will be the first ones to be paid from the enterprise. So, this trade off between risk and return in case of various decisions that the enterprise makes are called as risk return trade off. Now, we have taken the example of only investment and financing decisions, but there are certain other decisions that the enterprise also makes. Let's have a look at those decisions. The first decision is capital budgeting decision, that is also called as investment decision, that we have already understood. Second is capital structure decision, that is also called as financing decision. We have also understood that. Third is dividend decision, that is whether to pay dividends or whether to hold back that money for reinvestment in the enterprise. There are risks and returns involved in both these decisions or both these situations. And last is working capital decision, in which case what happens is that the company also needs certain money for regular or day-to-day administration or day-to-day running of the company. From where to raise that money, how to spend that money, and how much liquidity to hold in the enterprise also has certain risk and return involved. So all these decisions have certain level of risk and return, and the fine balance between these two things, that is risk and return, determines the market value of the firm. Therefore, the company has to very cautiously decide what is the level of return against the level of risk that it wants, and this balance will determine the market value of the firm. I hope you have understood the concept of risk return trade off. You can subscribe to my YouTube channel if you like this lecture. You can also join my Telegram group and Telegram channel for regular discussions. The link to both these things are available in the description section below.